On Hot Picks today, we are talking materials. Our guest has Albemarle as a top pick. He says this giant lithium producer should benefit from rising prices for the commodity. We're joined by Seth Goldstein. He's senior equity analyst at Morningstar Research. Seth, thanks very much for coming on the show. And we have seen something of a bounce lately in these lithium names, and you see more upside for Albemarle?
I do. I value Albemarle at $200 a share. So we still think there's a lot of upside, despite the fact that the stock has seen a pretty large rally from its recent 52-week low. And the rally's been driven by rising lithium prices. So since about the middle of the year, since early July, we've seen lithium spot prices in Asia, the largest battery market, start to rise. And while we still think they have much further to go, the rise has been enough for Albemarle to start improving its results. So when they released their third quarter earnings, we saw the company did see lower lithium prices, but they had lower unit production costs, which drove profit growth, and they generated positive free cash flow. And that is a sign that Albemarle is a low-cost producer. We have a narrow moat rating on the name because of its low-cost lithium assets. And so we think they can get through the bottom. And as prices continue to rise, they'll be one of the largest beneficiary as we see lithium demand growing faster than supply over the next coming years.
Partly because of electric vehicles and I guess large-scale energy storage, too.
It is. So we're seeing global EV sales continue to grow. And even though we expect that we'll see the U.S. EV sales fall next year as the tax credit expired in September, we do think globally we'll continue to see growth in key markets such as China and Europe. And so for lithium demand, it just matters that EV sales are growing globally. And then we're seeing the large utility scale energy storage batteries. These are being built to accompany solar and renewable projects. These are also being built in data centers to ensure grid reliability in new data centers. So here is a new case that's the fastest growing demand source for lithium. And as we've seen prices fall over the last few years, there's been a lot of supply cuts in response. And so now the market's going to move into balance due to the strong demand growth.
Your next idea, Nutrien, they are going through a pretty aggressive restructuring actually right now, selling off some important assets. Is that part of your bull case on the stock?
It is. We value Nutrien at $70 for the U.S. shares. And so we see a good upside to the current levels. And we think Nutrien's management is running the business very well. We like to focus on free cash flow generation. We like to move to divest retail assets and smaller businesses, smaller fertilizer mines in South America, where they tried to expand in that market to take advantage of demand growth from farmers, but they realized the returns weren't quite there. It wasn't as good of an investment as their expansions and their North American assets, both on the retail and fertilizer side. And so we credit management with being willing to walk away, divest assets, and put the cash flow either to share repurchases or to better investment projects in North America. So the company is underway divesting some South American assets. They're also reviewing their phosphate business, which has been one of the smallest businesses for Nutrien since the company was created years ago. But we do think that this business is less profitable, likely generates less free cash flow. And if they sell the business, they could use the proceeds elsewhere. So we like the move to at least review the future of the business.
It's interesting. The Globe and Mail reports today that Nutrien has selected a port in Washington state for a new export terminal worth up to $1 billion. Of course, that would be a blow to our government, which is trying to get infrastructure built in this country. We're trying to check whether Nutrien has actually done that or made an announcement. Finally, Qnity, and I hope I've said that right. I never can remember the pronunciation, but they make materials for the semiconductor industry.
That's right. So Qnity, and you did pronounce it right, was recently spun off of DuPont, and it's DuPont's semiconductor and electronics business. 2/3 of what they make are the chemicals and materials that you need to make semiconductors, and the rest is the chemicals and materials that you need for printed circuit boards to ensure things like our phones can connect to the internet, or in a data center that the devices throughout the center can have high connectivity so the data center functions really well. So these are very crucial materials as we see globally more data centers will be built out, phones will need increased connectivity over time, and we're going to see the need for more semiconductors and more powerful semiconductors. So we value Qnity at about $100 a share, so we see good upside to the name, and we think they are one of the leaders in these advanced materials and chemistries needed to support this demand growth, to support more smaller, more powerful chips, which do require better chemicals and better materials over time. So we think this is a good long-term growth, a good way to invest in rising semiconductor demand and increased connectivity over the years.
It is amazing the level of technology that the chip people are reaching right now, the tiny scales that they're operating at.
It really is. And TSMC is going to come out with transistors that are just 2 nanometers large, which continues to get smaller and smaller and more powerful over time, which makes our phones work better, allow us to do more as consumers. We ultimately get the benefit, even if we will be paying up for our future phones. But for a company like Qnity, they are working hand in hand with companies like TSMC and Intel to ensure that they can produce these chips and do so at good yields.
A nanometer being 1/1000th of a meter. It's just... it's mind-blowing what they're doing, yeah. Seth, we'd better leave it there. Seth Goldstein joining us. Thank you very much. Senior equity analyst at Morningstar Research.